gold under $2,000 is unsustainable.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. This is the show that goes beyond the headlines and uncovers the truth about what's happening here in the precious metals industry and the effects on the global economy in these historic times. You know, with exclusive access to experts and insiders, we reveal information and insights that you simply won't find anywhere else. Hi, my name is Shane Moran, and I'll be your host for this week's episode, and we'll be joined shortly by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of gold and silver and of the markets here, and we expose really what's really going on in the precious metals industry. So get ready for another blockbuster episode, and right here from Live from the Vault, we'll bring you the knowledge, we'll bring you understanding that the mainstream media won't provide. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, we've got a ton of questions here. Let's get this show started off here, but it's emanating from our last episode. We're following the 6 months into the 2023 trading. You updated us on what to expect and the all-important, again, we talk about this all the time, the physical gold versus the paper battle that it settles into the, you know, as it relates to the BASEL III compliance this year here. So let's maybe start off the show by talking about this ongoing battle.
Yeah, Shane, great to be with you again. Nice to see you back in the office rather than in some beach somewhere. But anyway, glad you're back. Let's start by updating the third and the fourth quarter setup, which is what most people want to know. Yeah, we've been through the first 6 months. And obviously not just for gold, but for joined at the hip silver. And what we're trying to do here is really to provide information that's not generally available, really. And the purpose really is so you can make, really, to assist yourselves and others in making comprehensive assessments, more comprehensive assessments. There's so much of a single narrative out there on so many things. Now, the culmination of the third and fourth quarter 2023 action is very much driven by a bullish physical gold versus this depleting paper gold framework, which since, as you say, BASEL III NSFR standards were implemented at the open of 2023 trading, what it's done is forced global liquidity providers, and we're talking about the first tier market makers here, to one-to-one back foreign exchange over-the-counter gold with physical bullion. If you remember, foreign exchange, gold is a foreign exchange cross, much like the dollar is to the euro, et cetera, et cetera. So obviously, they didn't used to have to back it. Now they do. So in other words, and the reason this was a game changer for the first time following over 50 years since Nixon had ended the ability to exchange dollars for gold bullion, when BASEL III reclassified this foreign exchange gold as a first-tier asset class on the 1st of January, what it did was forced the banks making markets in the multi-trillion dollar, I mean, this is talking about a multi-trillion dollar marketplace, foreign exchange gold marketplace, that is, to be actually one-to-one physically backed with bullion, which they never were. However, as we've drawn attention to, as a direct result of the Fed-driven war against gold following the weaponizing of the US dollar against Russia, and in turn, Russia weaponizing gold back in March 2022 against the dollar, the Fed-infested paper-settled COMEX markets have still not complied with BASEL III NSFR conditions. But what we're drawing attention to is that this disconnect between physically deliverable global foreign exchange gold has opened up a huge opportunity for all of us to capitalize on this fast closing window. Now, it's not fully realized by the majority of blinkered US traders because they're siloed inside the COMEX marketplace, banned from trading the deliverable 10 times larger foreign exchange gold markets, which as I say, a deliverable, that central banks and sovereign buyers are quietly capitalizing on this opportunity to exchange their rapidly depreciating dollars for bullion. And it's not easily apparent because physical buying is unleveraged and flies under the smoke and mirrors world of the massively leveraged derivative markets centered in the US. And we call this the COMEX tail wagging the physical market dog. We've talked about that multiple times. But the hidden opportunity lays in that this ever-widening paper market disconnect is reaching an inflection point that is evidencing the physical bullion markets irreversibly absorbing the remnants of this over 50 years of paper market generated liquidity. Now, while this divergent process has been muted by the Fed and its agent banks continuing to sell large swathes of leveraged derivative gold to prop up the competing US dollar treasuries and the weaponized dollar against foreign exchange gold, this tail wagging the dog activity has 100% been generated inside this siloed COMEX futures exchange, which is now the only remaining global trading venue that is non-Basel III compliant. And due to its cash-settled nature, COMEX derivative gold, whether you're long or short positions, are still able to be fractionally backed by gold, meaning global NSFR standards have not yet been implemented. It's important to understand that. But the timeline to compliance is closing fast. In fact, while we anticipate the same sort of attempted blocking action, as was evidenced, if you remember when they tried to implement Basel III legislation back in 2021, 2022, the LBMA, CME cartel, they came out, tried to block it multiple times. So the Bank of England failed. They absolutely failed. Now, interestingly, tomorrow, there's a Fed, and we're recording this on Wednesday, there's an upcoming Fed open meeting to discuss the final implementation of the Basel III international regulatory framework for US banks. That will also impact the large whale US-centric COMEX banks acting as market makers in gold futures. Now, so just bear in mind, we're recording this on Wednesday, and this is happening tomorrow on Thursday. So the Basel III proposal will ultimately bring the United States into compliance with Basel III risk capital requirements for all banks with over 100 billion or more of total assets. Well, that of course includes the Fed agent banks, which we call the cartel. And it means implementing a standardized approach to calculating credit, trading, and operational risk. And this will halt the ability of banks to craft their own models. And as far as gold is concerned, bringing the US into compliance with interchangeable spot gold NSFR compliant conditions, it will limit the amount of COMEX leverage able to be employed inside this siloed COMEX paper settled exchange, which will assist in removing one of the last levers employed to artificially suppress gold versus the dollar. What it means is that the already Basel III compliant over-the-counter market longs, i.e. specifically the bullion that hedges the leveraged COMEX shorts, because that is the relationship generally, what it'll do is it'll limit the unlimited leverage to just what can be one-to-one squared against the COMEX speculators still trapped inside the COMEX, but not beyond that. And as the largest published above-ground store of bullion is tracked in the GLD ETF, we've talked about that, is the only visible tracked store of bullion, and it's as represented by the GLD ETF, which we know is illusionary, and that COMEX positions can still be squared one-to-one against this ETF, which never needed to be backed fully. It's going to limit COMEX leverage. And it will also impact the ability to naked short this GLD ETF. There are a lot of ramifications to the US becoming Basel III compliant. And as would be, of course, expected, we've already seen lobbyists push back against, attempting to block standardized Basel III risk capital requirements to be implemented. I mean, why? Why do you need that against these 100 billion plus banks? However, the proposal really, when you think about it, only needs a simple majority of 6 members of the Fed Governor Board to pass. And given that the US is the only non-compliant marketplace, the bigger picture will ultimately force full compliance. And regardless, look, even if the Fed drags its feet for the next quarter, as long as the US stays non-Basel III compliant, the dollar will come under pressure against compliant jurisdictions. And as we have already drawn attention to in multiple episodes, as far as gold is concerned, as a direct result of these leveraged, unbacked, fractionally backed COMEX gold positions already being accessible to the compliant liquidity providers through this synthetic market EFP backdoor. Remember, the EFP backdoor is simply that the way of getting bullion out of the COMEX exchange that turns into an unallocated gold position momentarily, but as soon as it lands in London, it becomes physically compliant. And it enables these otherwise undeliverable, highly leveraged fiat gold positions to be converted into unleveraged, net stable funding compliant, deliverable physical gold on a T+2 basis. In other words, so when it arrives, it has to be delivered within 2 days under NSFR regulations. Now, the pricing variance has essentially opened up a Bretton Woods window to convert fiat dollars to physical gold, enabling competing central banks and sovereigns the opportunity to alchemize deeply underpriced dollar-denominated paper gold into physical gold pegged at each paper-driven daily local London fix. So whereas before, Bretton Woods, there was a set price, now that is based on whatever price it's fixed at. Nevertheless, a huge opportunity. Look, gold under $2,000 is unsustainable, and it offers stackers and those seeking a first-tier zero counterparty risk wealth protection vehicle a massive opportunity to act now while they can. And the pivot point where this Fed-induced derivative gold leverage backfires, triggering full compliance and a gold market price reset that reflects real supply-demand fundamentals, is being brought forward, driven by the strongest reporting competing global physical gold demand since Nixon closed the dollar exchangeability pegged to the fixed price of gold. Even larger accompanying central bank monetary gold demand escapes central bank reporting requirements and flies under the radar, guys.
Now, Andrew, we know that you track the global wholesale market flows, which are, we've talked about this before, but these are historically large central banks and sovereign buying physical gold at levels that haven't been seen in over 50 years. Now, is this continuing, and why is it continuing, if so?
Yeah, Shane, exactly. Why are global central banks and sovereign buyers racing to buy physical gold into this rapidly closing discount window? And the answer is just simply clear, because they're preparing for the birth of Bretton Woods III. Directly after the dollar was weaponized against Russia in March 2022, Zoltan Pozsar, his excellent paper on the first, and that was way back then, he was the first to outline how a new world monetary order will be centered around commodity-based currencies anchored in physical gold, outlining he outlined extremely well how the unfolding playbook for this evolving non-dollar-based commodity currency would roll out. And as was reported by the US official mouthpiece Reuters last Thursday, the US are attempting to halt the BRICS currency being discussed at the BRICS August summit. However, while severe US pressure has clearly been put on the South African government to block Putin from attending, which they have, followed by South Africa's BRICS ambassador, playing down that gold-backed currency would be tabled, our Russian contacts continue to reaffirm that the very well-developed structure of the proposed gold-backed commodity currency is most definitely front and center of the upcoming summit. And of course it will be. What Reuters fails to focus on is the plus 40 nations that have expressed an interest in joining the BRICS Plus trading bloc, and that the unipolar weaponized US dollar is, one way or the other, going to be circumvented by this massive multipolar trading bloc. That is the glue that will bind this trading bloc together. In order to replace the dollar, and with no single currency, that could be the yuan, the ruble, liquid enough to replace trillions of dollars of the energy and commodity trade between these nations, there is only one solution: a gold-backed commodity currency. And if it's not 100% backed with gold, it will be partly backed by gold. Really interestingly, we see Kennedy a couple of days ago come out and talk about backing the US dollar with metals, even if it's a small amount. Well, unfortunately, that killed his uncle, Robert Kennedy, all those years ago. It was doing exactly that. But it's interesting because people are waking up to the fact, hold on, something has to be done. And this is why every single member and the new applicant seeking to join this trading bloc has been buying physical gold openly, and as far as monetary gold is concerned, it's just off-grid. Once this currency structure is formalized, the US-centric derivative gold market will be forced to fold. It is that simple. It has to. I'm not saying it'll happen overnight, but it has to. Also, there's no coincidence that UAE and India, you're like this, Shane, their economic partnership agreement just came into force, but details are just spilling out. The partnership moves to reduce silver import and taxes to zero by 2032. So immediately we have a 15% premium that will reduce to 9%, then gradually to zero. This will trigger very, very large Indian silver demand. Monetary gold duty rate will also reduce to 1%, which is going to severely cut smuggling, the need to smuggle. Now, with all of these partnerships being cemented, we once more need to underscore that the Bank of International Settlements, along with every other Western central bank and every single first and second tier bank, except the wrong-footed Fed, are long physical gold, anticipating much higher prices into a multipolar pricing environment. Also, ultimately providing these forward-looking central banks the option of revaluing gold held in their underpriced gold revaluation accounts. We've been into some granular detail on how that works in prior episodes. It's a simple process, and it can be effected simply by selling their underpriced gold reserves and rebuying them at market simultaneously. And with US Treasuries and currently valued at $42 an ounce, revaluing gold at, say, $2,000 would reinvigorate a rapidly depreciating unbacked dollar. Doing so would hide the rehypothecated nature, the double ownership nature of these 8,133 tons of Treasury gold. So, of course, the upcoming played down BRICS summit reveals a front and center attack on the US dollar, which is clearly what this is. So watch out for a lot of upcoming distractions. We're going to see saber rattling, war escalations potentially in Ukraine and Poland, an uptick perhaps in Taiwan rhetoric, trade war escalations with China, a possible false flag attack. I mean, nothing would surprise us, all of which, very short term, may draw Western markets safe haven demand into treasuries, evidencing the Western markets initially racing into safe haven dollars. But the serious escalations will concurrently also drive physical gold demand. It's not the game that it used to be. And with the US dollar and treasuries they're going to ultimately give their games up when things settle down. But any additional gold demand will not be undone, and it will assist in depleting supply being offered at current levels. That's a fact.
That's amazing. Now, Andrew, just before we started recording here, you were saying something about that you're seeing something immediate. Can you share with our viewers what that is?
Yes, Shane. Glad to. More immediately and directly related. Following high-level meetings last week with a major refinery alongside first and second tier liquidity providers, the Bank of International Settlements also reached out, really seeking now to gather information on how gold-backed stablecoins and as such, our decentralized Kinesis gold-backed currency might fare into a buoyant physical market. Clearly, they're looking at all options. But what these comprehensive discussions reveal is that a much stronger, unprecedented central bank and institutional uptake of physical gold on a global level is underway. Now, these meetings also reaffirm our assessment from long ago that from last November, that the Bank of International Settlements is long gold for their own book, which, considering they act on behalf of other central banks, indicates every central bank except the Fed, that's Europe through Asia, Africa, Russia, China, or, right across, are now hedging the recently weaponized dollar and the perceived high counterparty risk treasuries with physical gold. Now, this is massive. It's just not being discussed by the mainstream media. In fact, it's being deliberately ignored. And as we've been drawing attention to, this leaves the Fed as the sole outlier, the only central bank still capping bellwether gold as it competes against freshly printed Fed-controlled dollar and treasury supply. However, net of what we see flowing out through this EFP backdoor, official gold capping efforts seeking to bolster this illusionary demand for the dollar and US treasuries are increasingly constrained to how much inversely sold paper gold can be contained inside this siloed cash-settled COMEX exchange. And given the ballooning level of US and related debt is ultimately telegraphing a future US Treasury default, we are witnessing a major move by central banks and sovereigns into the only first-tier liquid asset class that has zero counterparty risk. Clearly, physical gold and related silver. They are liquid enough to control this. Now, over-the-counter gold alone is a $13 to $15 trillion a year market, but add in derivatives and it is into the 70 trillion mark. So, and then that's not even accounting for all of the relationship with the quadrillions of derivatives. Now, the Fed is now recognized as the only buyer of treasuries in any size. And given first tier physical gold directly competes with US Treasury demand, this ill-conceived paper gold battle continues, but it's running against an increasingly divergent, very strong global demand physical gold marketplace.
Hey, Andrew, that's quite astonishing. And most investors wouldn't think of U.S. Treasuries as even having a remote chance of defaulting. Should this give people pause or thought when weighing up gold as a competing first-tier asset class here?
Yeah, I mean, Shane, especially as we're weighing up gold as a competing first-tier asset class. I mean, the Fed is fully exposed to plus 50 years of accrued, rehypothecated, double ownership, triple ownership, quadruple ownership, who knows, it's not audited, undeliverable derivative gold bets, which have been caught extremely wrong-footed, unable to exit thousands of tons of underwater derivative gold exposure. So clearly, this massive miscalculation has created a huge opportunity window for us and central banks to secure cheap bullion before the Fed is forced to fold its hand. This looks to be on the front burner. So let's see what tomorrow's Fed meeting will reveal, the one that we're talking about, bringing Basel III standards into the US. And you'll obviously, when this is published on Friday, you're going to know what that was. But to circle back to your original question, Shane, What we're currently witnessing as we progress deeper into the third and fourth quarter is an accelerated divergence between Fed price paper gold as determined inside this siloed COMEX cash settled exchange versus the real, very strong demand physical market. Hence, the very short-term counterintuitive capping that we have been witnessing, while conversely, these paper-centric automated siloed gold and silver capping algorithms are actually being fished by some very smart money for conversions to physical. So very short-term, this brings us to the current. Now, if you remember, we looked at the trade at settlement lever, this disruptive lever, which escapes a lot of, it really escapes what the regulators see all the time. So now, whereas the volumes are once again, these volumes have been rising to severely imbalanced levels. And we've spent the time in previous episodes really dissecting the derivative game. But to sum up what we see now, while on the face of it, these plain vanilla $38 contango capture, that's what it is. So basically the difference in carry costs for the December contract being sold versus the August contract being bought. So basically you're then capturing that by the time it gets to expiry. Now, look, this is legal and legitimate neutral stance strategy where an equal volume of August longs are balanced with an equal number of December shorts. But it's not the on-ramp that's the issue, where both trades are executed at exactly the same time. Actually, there is some leakage, but we can talk about that another time. But it's the off-ramps, which allow these agent swap dealers, the cartel, to rig downside air pockets by illegally exceeding intraday position limits, something their footprints revealed last Monday and Friday and every day this week as we approach options expiry. Actually, we're now evidencing a phase of off-ramp August longs being closed before the December shorts are covered, hence the magical containment into the options sweet spot today, the derivative sweet spot, where bets are marked to market. But interestingly, reflecting less resistance into the end of the year. So we're seeing further out, these bets are actually, we're seeing some plain vanilla December longs being added by insiders. So we see this structure changing. And while we're going to continue to see some disruptive squaring, you watch of these August to December trade at settlement positions into the December options contract at today's insider held options positions expire. And then we've got August going into delivery on Monday on the 31st. So you'll see that as after this is published on Friday, with the back EFP door already witnessing very large conversions to spot of COMEX outflows into spot. And these predatory agent banks, sanctioned swap dealers are now increasingly constrained to capitalizing on really the plain vanilla average $38 contango in this instance. With competing central banks aware of this game, there is far too much leakage of casino chips being converted into physical gold. However, while the Fed agent banks are actually trying to cap gold, we're also evidencing these very same banks, including every other first and second year bank, aggressively adding physical gold to their own house accounts. Why wouldn't you if you're that close to the market? And we continue to have dialogue with our Russian contacts who report increasingly large agent spot gold demand, as well as competing Moscow Futures Exchange demand now becoming relevant. Spot gold in Moscow continues to match London foreign exchange gold. It's tick for tick, at a minimum trading at a flat to $1 to $2 premium. Interestingly, into the gained trade at settlement air pockets last Friday, Moscow spot commanded a very large $10.30 premium to local London spot. In fact, I just checked just a few minutes ago, today on Wednesday, and currently that is spot is commanding an $11.80 premium to local London spot. Look, this is drawing Indian demand away from London. And while notably Moscow futures are now closely matched with the December COMEX futures contract, or trading at a $29.90 premium to the August contract, off-grid, these competing increasingly liquid, and I will underscore increasingly liquid, Russian spot and futures premiums are attracting bullion in size to circumvent the legacy ring-fenced containment market and is tightening Western bullion supply. So really, to sum it up, the war against gold has opened up competition and it's getting traction. We continue to see the BRICS summit next month as the pivot point and want to add to our bullion holdings ahead of this event, hence closely tracking the unprecedented daily TAS trade at settlement volumes, which may offer an opportunity to buy discounted gold and silver into the end of the month's gold and silver paper market containment. However, given the strong physical uptake and ability to EFP these paper gold into deliverable gold positions, we see dips are shallow and quickly jumped on.
Andrew, for everyone in the community that is a trader, do you have any kind of short-term observations on what they can expect?
Yeah, Shane, the August options expiries and FOMC today will largely evidence the last squaring of these onerous trade at settlement spread trades being squared. Now, this episode will be published, as I say, on Friday, so you'll know the outcome. But we've already evidenced several disruptive legs of the expiring August longs being squared ahead of the directly related December shorts being closed, creating air pockets. However, as we reported after our last options expiry last month, and which was the 29th of June, the rising very large central bank bids at spot 1950 have consistently been front run by these predatory Fed sanctioned agent banks. Now, this follows, as I say, specs being extremely wrong footed naked short at 1900 into last month's June's options expiry on the 29th, which was their way of squaring up all their derivative bets. But as we said, this looked like a miscalculations. But because the lion's share of these momentum specs, which had created this overshoot into central banks' hands, had only just short covered now on the crust back up about 1958.70, which they tend to trade on the moving averages. That was the 100-day moving average. And just for reference now, the 100 is at $1,970 today. Now, this is another reason we're focusing on this inflection confluence, which has so far generated very little spec long open interest for insiders to ignite. So if they aren't long, what have you got to ignite? So that means that anything below that level is naked short specs and will be short-lived because the commercials will be on the long side of it. So regardless, wholesale market footprint suggests that central bank stair-step support is migrating higher from last month's 1900 level to spot 1950. We're watching this really closely. And if this proves out, and we'll know following OPEC gaming and FOMC today, then the agent bank insiders will not want to miscalculate another large aggregation of central bank physical orders being filled, this time $50 higher per ounce than the trade at settlement gaming into last month's options expiries. Look, if you're a trader, gold sub 2,000 is a no-brainer bargain, and silver sub $26 is an absolute steal. Longer term, silver looks cheap sub $100, and gold looks really cheap sub $2,500. But look, there's only one question remaining in our minds. How much gold and silver, guys, do you own now?
All right. Thank you, Andrew Maguire, for talking gold. And remember, to all of our Live from the Vault community members, buy physical and make sure it's backed 1-to-1 and understand the difference between what Andy affectionately calls the casino paper and gold, silver markets, and the actual physical gold and silver markets, they're not the same. We've been talking about it again, show after show. Don't be fooled. And there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. And please help keep spreading the word about this channel. Thank you very much for everyone by hitting that like button right now and share this information. Hit on the subscribe. And if you hit on the bell right there, you'll be notified as each episode goes live. And with that, we'll see you right here next time on Live from the Vault. See you then.